Approximately 70% of individuals that convert their traditional IRA to a Roth IRA are clueless about the tax implications that this will have for them. And that's according to Kiplinger in an article that they wrote called "Everyone is Talking About Roth IRA Conversions. Here's Why." Hello, my name is Tommy Cloud. I am the founder and president of Third Act Retirement Planning, a company that I started back in 2000. I am also a certified financial planner and qualified kingdom advisor. And we help Christians who have recently received a large sum of money to make biblically sound financial decisions. In today's video, we will be discussing the 7 deadly sins of Roth conversions. So let's go ahead and get started. And maybe, just maybe, we can help you avoid some of these mistakes. Mistake number 1 is a lack of awareness of the pro-rata rule. If you have a traditional IRA where you have made after-tax contributions into it, then that portion is not going to be taxed when you convert to a Roth IRA. So if you have a grand total of $100,000 in a traditional IRA and you have contributed, say, $25,000 of it is non-deductible, then when you make that conversion, 25% of your conversion to the Roth will not be considered taxable income to you. Mistake number 2 is converting too much in a single year. The way the tax bracket system is designed by the federal government is that there are 2 very large jumps, one from 12% to 22%, and then one from 24% to 32%. And that's under the 2024 tax bracket. So if you convert too much in 1 year, you might make that big jump, that big 10% jump from 12% to 22, or you might make that other big jump from 24 to 32. This one is an interesting one, but number 3 is going to be ignoring the full tax consequences of a conversion. Some people will make a conversion into a Roth IRA and they believe they're going to be taxed at the capital gains rate. Let's be very clear here. You can convert in 2024, you can convert $583,000 of income and only be taxed 15%. So anything above $583,000 will only be taxed at 20% if we're talking about the capital gains rate. However, a Roth conversion is full-blown taxable income, and it's going to be taxed at the federal income tax bracket for your filing, whether you're single, married, filing jointly, married, filing separately, head of household. All right, I'm going to explain this without a graph. Mistake number 4, I'm going to call not being strategic to minimize tax burden. This has a lot to do with the consideration of Social Security income. Many of you might be thinking, okay, I'm single, I'm above 34,000. I know I'm going to get hit. There's nothing I can do. I've got a pension coming, a real estate income coming to me. I have a taxable account with millions of dollars in it that's producing interest or even muni bond interest, because they count that towards whether or not you're going to have your Social Security income tax. We're not just worried about whether or not your Social Security is going to be taxed at 85% or 0 or 50%. That's important, but we're not going to live and die by that for many people. So let's just go ahead and assume that no matter what, your income is going to be above 44,000 and your Social Security is going to be taxed at 85%. Let's say that you're 64 years old and you haven't started Social Security and you've still got $500,000 in your IRA. You can make these conversions strategically until you get all of that money out of your IRA into your Roth IRA at lower rates. It's once you start that Social Security, it's going to go towards your adjustable gross income in this scenario. So why not hold off on taking your Social Security, convert everything from your traditional IRA to your Roth before you start Social Security? That way, the conversions are not as easily get up to the top of each bracket as quickly, because it won't have that Social Security. And remember, half of your Social Security income is going to count towards your adjusted gross income. So we're talking an extra $22,000 per year that you can convert for a married couple just by waiting, and an extra $17,000 for a single person that you can convert just by waiting to take Social Security. If your Social Security is $50,000 a year, then they're going to add 25,000 to your adjusted gross income. Mistake number 4, again, not being strategic in understanding and minimizing the tax burden. Mistake number 5 is paying the taxes out of your traditional IRA versus one of your other taxable accounts, which could be a brokerage, a savings, or a money market account, for example, even a checking account. If we start on the left side here, you can see that you're taking $100,000, converting it to a Roth. You're not paying any taxes here out of your traditional IRA. You do have a brokerage account over here that has $25,000 in it. At the end of 5 years, with a 5% growth rate, the IRA has grown to $127,628, while of course your brokerage account is zero. As you can see, the grand total is $127,628 in your Roth IRA now, which you can withdraw tax-free, by the way. And it can continue growing tax-deferred. We're going to, on the right here, let's take a look at the traditional IRA and using the IRA proceeds in the traditional account. So we start with $100,000, but we pay $25,000 of taxes out of the traditional IRA itself. We do not pay any taxes out of the Pro 5 years. You've got a grand total of $100,000 to invest in both situations. At a 5% growth rate, the traditional IRA will grow to $95,721. The brokerage account will grow at 4% instead of 5% because you're having to pay those taxes each and every year. And it's going to be $30,416. Remember, also, any interest, dividends, and short-term capital gains are going to count towards your income. So keep that in mind here, keeping the brokerage account. So it's all going to contribute to your bracket that you're in. Whereas a Roth IRA will not. It will grow tax deferred. At the difference, about $1,500 less in your Roth IRA because you paid the taxes out of paying them out of one of your. Okay, we're just going to look at the benefits of tax deferral, paying your taxes out of your traditional IRA account instead of one of your taxable accounts. We want to look more at the benefits of tax deferral because that last graph I showed you was only 5 years. But what if you went to 20 years? Look at the difference in $500,000 over 20 years. You could do these conversions in your 60s before you start your Social Security at the age of 70, and you could live to be 85. That's 20 years. Look at the difference in that. At a 7.5% per year return, and then 0% tax, of course, for a Roth, 1% or 2%, depending on how your investments perform in your taxable account and what you or your financial advisor puts you in. But you can see that's a substantial difference. So you're 85 years old, let's say, you converted everything by the age of 65. If it's a 1% per year difference, that's still about $500,000 almost. You got 120 plus 200. So that's $400,000. And this is almost $750,000. That's a substantial amount of money for your family or yourself at the age of 85 to miss out on because you decided that you were going to pay all the taxes out of your traditional IRA account. All right, we're going to get into the wildest one of all here. When I hear people talk about they're predicting, and this is number 6, predicting the future tax bracket that the government's going to enact. It's a very interesting discussion. As you can see, going back, this graph goes all the way back to 1910. And you can see that the top bracket got all the way up into the 90s, 91%. And even here, right here, this point in the graph is into the 60s. This is in the late 70s. The top bracket was at 65%. So as you look at where we are historically, taxes have not been this low since the beginning of the Great Depression in 1930. That's the last time taxes were this low as to where they are now. This starts right here at this line of 40% for the top bracket starts at 1986. But in the modern era, since 1986, taxes have been relatively low since 1986. So trying to predict what the United States government's going to do with the federal income tax rate, I think that's probably, arguably, one of the most foolish mistakes that we can make while thinking about converting into a Roth IRA. All right, this one's going to be a quick and easy one. Mistake number 7 and our final mistake for Roth conversions is converting up until, I hope this video is beneficial to you. If you want to set up a time to briefly talk about whether or not it would be good to convert your IRA into a Roth IRA, then just click on the link below. Until next time, I'm Tommy Cloud with Third Act Retirement. I hope this video was beneficial to you and that you learned something that will help you prevent some of the most common mistakes in converting a Roth IRA. If you'd like to go over your IRA situation and whether or not it would be wise for you to convert an IRA to a Roth IRA, just click on the link below and schedule a brief call or meeting with me. I'll take a look at it with you and see whether or not you should make that conversion.